Good morning, good evening, and welcome to our panelists and to our audience members joining us from around the world. My name is Stephanie Cater. I'm a partner at the Bridgespan Group, which is a global social sector advisory firm that serves impact investors, philanthropists, and NGOs. And I'm a proud alum of the University of Chicago Booth School of Business. Welcome to the panel discussion today, titled Turning Down the Temperature: How the Finance Industry is Impacting Corporate Climate Action, as part of the University of Chicago and Peking University Joint Forum on Addressing the Climate and Energy Challenge, and in partnership with Rustandi Center for Social Sector Innovation at the University of Chicago's Booth School of Business. Before we begin, a few housekeeping items. First, to listen to today's program in Mandarin, click on the interpretation icon at the bottom of your screen and select Chinese. Second, please feel free to use the Q&A function to submit questions in either Chinese or English throughout the event. Today's topic is an interesting and an intriguing one. As climate concerns accelerate and trillions of dollars are managed with a climate-related lens, corporations face increasing pressure from investors, asset managers, and banks regarding their carbon footprints, climate strategies, and environmental disclosures. Investors clamor for accurate and standardized corporate reporting to help them inform their investment decisions. Is it investor overreach, or is it not bold enough? Today, we'll hear from corporate, financial, and reporting experts as they discuss the current implications and impact of this market dynamic. It's my pleasure to be moderating a panel today with three esteemed guests, and I'm going to invite them to introduce themselves. First, we have Dr. Chi Bean. Dr. Chi, could I invite you to introduce yourself?
Okay, thank you, Stephanie. Thank you. Good morning and good evening, everyone. My name is Chi Bean. I'm the Executive Vice President of China Investment Corporation, CIC, China Sovereign Wealth Fund. I am especially excited to be part of today's forum, jointly hosted by Peking University and the University of Chicago, because I studied at DOC for my MBA in the mid-90s. I grew up in China, received my undergraduate study in physics in Tsinghua University, the famous rivalry of Peking University. I went to the US for my graduate study in 1992, first in biophysics at University of Rochester, and then in business and finance at the U of C. After graduation, I spent a few years on Wall Street with Goldman Sachs and some other firms before returning to China to join the China Security Regulatory Commission, CSRC, where I worked for 16 years, helping liberalize the mutual fund industry in China and open up China's capital market to the outside world via PFII and the Shanghai Hong Kong Stock Exchange. Shanghai Hong Kong Stock Connect. I joined the CIC in 2016, and I'm currently supervising CIC's direct investment arm, CIC Capital. Thank you.
Thank you for being with us today, Dr. Chi. Our next panelist comes from us from the corporate world. James, could I invite you to introduce yourself?
Hi, good morning and good evening, everybody. My name is James. I'm the Vice President for Sustainability of Danone, and I'm also the General Manager for Social Business of Danone in China, where I oversee a 10 years old social innovation project where we started with a Nobel Prize laureate, Professor Yunus, 10 years ago. So I'm also the current co-chair of China's Sustainability Steering Committee of Consumer Goods Forum, an international alliance of manufacturers and retailers of consumer goods that promote joint efforts in sustainability. And also I'm the Asia member of B-Labs, Standards Advisory Group, an independent non-profit organization that promotes B Corp certifications. So my background basically in the consumer goods industry. Previously I served as general managers and head of China for Carlsberg, and also in the commercial roles with Unilever. So at the moment, I spent 6 years with Danone in the area of sustainability and ESG related area. Thank you.
Thank you, James. It's a pleasure to have you and very excited to hear your points of view. Our third and final panelist is Bob Mann. Bob, could I invite you to introduce yourself as well?
Yeah, hi, I'm Bob Mann, and I'm with Sustainalytics, and it's a ESG data and ratings and information firm. We've been servicing the financial services industry for over 15 years. And I think for the first 10 of those, or 12 of those, we're an independent organization. And recently we were acquired by Morningstar, so now I run the business unit within Morningstar. And yeah, it's been an exciting ride to sort of experience the evolution of ESG from, I would say, the earlier days, not the earliest, but earlier days, to where we are now. It really is a step change and exciting. And yeah, and these types of events really add fuel to the fire. So happy to be here and excited.
Happy to have you, and it has been an exciting ride indeed. And Bob, I might address the first question to you. Part of the concern about ESG ratings is exactly what they're measuring. Is it financial risk to the company and investors or actual risk to the environment? Do you think ESG investing has a specific purpose or should? And if so, what do you think it should be?
No, I don't think there's a single purpose to ESG investing. So maybe that's the starting point. And I think the more sophisticated and long, participating parties, so let's say institutional investors, who I think have been part of the ESG movement longest, they're not confused. I mean, for the most part, that community understands that they're trying to understand the ESG risks associated with their investment decisions and have a fiduciary duty. I think what's happened is that as the umbrella has widened, and there's more and more parties, and I would say less sophisticated parties, so individuals and advisors, and I would say the retail market, it's been less clear, and there's been more motivations, and I think that's what's really caused the difference. And I think it's important that participants understand the difference between looking at measuring ESG risk, which is really the consequences of ESG considerations on the company. What does it mean for the company's performance? And when we talk about impact, we're talking about what is the company's impact on its stakeholders and the consequences of that. And really, we're looking at two different concepts, and it's important that they remain clear. And I think that really would help the space. I mean, so for example, in Sustainalytics, our risk rating is just that. It's an ESG risk rating. We look at the exposure a company has to ESG risks and the ability to manage those risks, and we rate those risks from severe to negligible. On the flip side, we're going to be launching an impact rating soon that really looks at the extent to which a company has the possibility to contribute to a sustainable future and the extent that they're doing so. So I really think it is doubling down and understanding the intent, but I do think the tools associated with ESG do need to service multiple stakeholders and multiple use cases. So I hope that answers the question.
It does, absolutely. And it makes the picture even more interesting and complex when there are multiple uses for a tool, but it also makes it even more important to have those. James, I'm curious, given where you sit in the corporate side, what are the greatest challenges you see in achieving sustainability, such as influencing the behavior of your supply chain? And what are the steps that Danone has taken? Are there lessons there for other companies from you, someone who's been on this journey perhaps longer than others?
Yeah, I think the first challenge is the paradox of a very long-term horizon of sustainable goals. We are talking about 40 years for a long-term goal, and interim could be 15 to 20 years, like carbon neutral for the factory 20 years, and then 40 years for the full scope carbon neutrality. So compared to a business plan of maybe quarterly, yearly, or maximum 5 years, a strategic plan. So this is a big mismatch. So for us, I think fortunate that we are mission driven. We have a 50 years journey of a dual mission of both social and economic. So that helped us to take steps on much earlier steps on decarbonization journey, for instance. Even in China, we started our carbon footprint tracking for the last 13 years. So today we have 2 factories of our bearish business announced to be carbon neutral. And next year we have 6 factories of our bearish business to be carbon neutral. So the last 13 years journey was very lonely. It's not driven by the environment, but more driven by our mission. But that allowed us to engage our supplier much earlier. So we have long-term commitment. At the same time, we have interim targets and milestones that allow ourselves and our suppliers to maneuver with the resources allocations and also adapt to the changing environment where opportunity too comes along in between. So the second challenge is transparency. So lacking transparency, disclosures in the supply chain, where supply chain and indirect emission contributed 80% of our emissions, more than 80% for the consumer goods company, like upstream supplier, raw material, transportations. So what we did is that what we did is we encourage our suppliers to upload their environmental related performance data into a public domain. So fortunately, there's a public domain called Blue Map based in Beijing, managed by an independent nonprofit organization called Institute of Public and Environmental Affairs, IPE. They have 2 million database in this open source platform covering 16 industries. So over the last 5 years, we see the changes in behavior of our suppliers. So from hesitation to accustomed to a more transparent and green supply chain. The other challenge is like, for instance, transportation is beyond our control, right? It's in the ecosystem. So instead of waiting for the whole transformation of the transportation to be in green transportation, it might take a long time. So what we did is we engaged our logistic partners to do some pilots with electrical forklift, electrical delivery vans in 5 cities in China. So this is much better engagement than training conceptual. So we let them participate to feel the momentum of the EV, how the EV coming up. So today EV is 23% of China market. So most likely before 2030, it will be mainstream, more than 50%. So then they are prepared to grab the opportunity of scalability once it comes into mainstreams. The other one is we engage our potential supplier much earlier, especially the innovation. So recently we announced investment in carbon captured packaging material research and development with LanzaTech, a young up and coming company in the packaging technology. This is amazing because it has dual reductions. First of all, it captured the carbon dioxide from the atmosphere and convert them into a plastic packaging. So it reduces carbon from the air. At the same time, it replaces the petroleum-based packaging material like virgin PET. So, but it is a long-term commitment. So I think we have a long-term commitment, consistent commitment, but we do have interim milestone that allow maneuvering so that then we can balance with our P&L, financial allocation, and have our suppliers adjusted along with the evolving environment. Thank you.
Thank you. That's fascinating to hear. And you hit on something that I know we want to dive into more in the panel, which is just around where the impetus for some of this action, all of the actions you described is come from. It sounds like for you all, it's been a mission-driven impetus for a long time. And I want to come back to you on whether you think that's evolving and where you think it should come from in the future. But first, I'm very eager to get Dr. Chi into the conversation. Dr. Chi, we see that sovereign wealth funds are playing this increasingly active and role in global investing activities, and they can have an impact on the transition to include ESG investment strategies as well. The China Investment Corporation is the second largest sovereign wealth fund and manages over $1 trillion in assets. Could you please talk a bit about the approach CIC has taken in climate investing?
Okay, thank you, Stephanie, for the question. In recent years, it's becoming a consensus that financial institutions should play their due role in addressing the climate change challenge, mostly to provide funding to incentivize greener, greener growth. Sovereign wealth fund, in my view at least, should be more socially responsible than ordinary financial institutions, and therefore should do more. CIC's sustainable investment initiatives have at least three dimensions. First, we have established an ESG policy weaved into our entire investment process. For example, we're just setting up an ESG evaluation framework for our external manager selection. Secondly, in the public market, we invest both in ESG indices and run our own ESG stock market portfolio. Thirdly, at CIC Capital, which is my territory, the private equity / direct investment sector, we have also been very proactively making investment under the climate theme. For example, we invested in both infrastructure and the traditional private equity fund managers with energy transition technologies and services. Last year, we set up a strategy dedicated to the investment in green energies. Most recently, together with our GP, we invested in a portfolio of timberlands in the US, which will potentially produce 28 million carbon conservation credit. We are particularly interested in investing in climate transition-related innovations, which I believe can provide the ultimate solution to the climate change challenge, which I will get back to. Thank you.
Terrific. Appreciate you sharing the exciting initiatives underway. And it sounds like we are all in agreement that addressing climate change is a really important goal, and that there are a number of different roles that you all in your organizations are playing, and that broader other actors in the field are playing as well. I'm interested in hearing from each of you what you think the respective roles are of the public sector, the financial sector, and the private sector, and what the best levers are to encourage this. I encourage any panelists who wants to jump in first to go ahead. We'd love to hear from all three of you, your thoughts on the respective roles.
Maybe I'll jump in then. And quiet. I think it's relatively obvious that you need all those participants to participate. So I don't think there is simply a private market solution to these issues, because I think in many cases there's externalities and other things that require a broader structural process to address them. And so I think regulations, if we say it, are a necessary part of any solution, and as a policy that cuts across. I think it's necessary to create the appropriate circumstance or playing field for the private parties who are going to participate. And I think once you get to that point, then you have, I think, both corporates and in the investor community have certainly an important role to play. I think in the way we view the world is, in the end, it's the corporates who have direct impact. They're the ones whose direct activities create the benefit or the harm. And really, I think it's investor decisions that are there to help, I would say, add pressure or add support to those corporate actors. So really, I think it is the corporates who really make the difference. I mean, it's their actions that make the difference. And I think both our job as financial services service providers is to help sort of bridge the gap between the investors and actually the companies themselves. So we help inform and provide support for good investment decision making that takes into account more than just financial results. So that would have us it. But I do think it's probably all for naught without some strong government participation, because I really do think it's necessary. And I don't think the solution is really just, I would say, private markets doing it itself.
Maybe I speak from the corporate point of view. I think climate issue is a complex. It's not a standalone solution from any one individual company. So I think it involves the whole ecosystems that I don't think standalone solutions from one company. Collective actions is critical. And I think each of the players in the ecosystem has a roles of being buyer or seller. So being a buyer, you do exert a lot of influence to the environment from your from your suppliers. So I think traditionally, each player exert pure economic value, exert pressure for influence for maximize the economic values like price, trading terms, margin. I think it's time now to include certain elements, relevant and impactful elements of climate, for instance, into the influence of the ecosystem. So that for the consumer product industry, for instance, we do have enormous influence to our suppliers. Similarly, our retailers has a lot of influence on us as a product manufacturer to retailers. So at the same time, you play both ways, that you can shape and influence our, for instance, manufacturing brands to influence our consumers, and for the retailers to engage and educate the shoppers, for instance. So then I think this role might come from trade associations, coalitions. This is where I think the consumer goods forum representing manufacturers and suppliers are promoting this in the whole ecosystem. So it reduces costs, it leverages expertise of different players, and then it harmonizes the whole value chains, to add values to everybody's. Thank you.
Well, I tend to agree with the two panelists' view. Obviously, addressing the climate change challenges a daunting task and takes collective efforts from our society, governments, corporates, financial institutions, consumers. They should play probably different roles, and I think they should fulfill what I call shared and divided responsibilities. For example, governments should provide a policy incentive, because a lot of the climate change initiatives may not be economically viable at early stage, and the corporates should manage their own carbon footprints. Consumers should make green choices, and financial institutions, as I said, should provide funding for greener growth. In particular, I think in improving energy efficiency or promoting energy transition.
Maybe I just want to. I think there's something interesting going on, because I think we all talked about the need for collective action, and often government can be a catalyst for that collective action through regulation or other means. I do think it's interesting that maybe there's a bifurcation, or even more than that, of how the world is moving forward on this, right? So you see real momentum building, in Europe, and I would say in Asia continues to build momentum. But I mean, it's pretty clear to see that there's a more messy circumstance, emerging in the U.S. And so I think that'll be an interesting that will be an interesting thing to understand going forward, because many organizations are global players and many of these issues are global. So how navigating, I would say, this emerging difference in global perspectives and how that'll impact things like trade and how companies act is really going to be a complicated and interesting, world going forward.
Yeah, it's a great observation, and the bifurcation really is fascinating. It sounds like in this group there's a lot of alignment on the need for collective action, as you were saying, Bob. And then we also do see pushback out there. So, for example, one mechanism that has been established is the International Sustainability Standards Board, or the ISSB. And we're in that represents international agreement in the space of reporting, which is a terrific step forward. And simultaneously, we're seeing pushback from regulators. So to use one example, the letter from the American Bankers Association recently. So I'm curious in how each of you view that pushback. You sort of have established points of view, and you've been in this space a long time, and you and your institutions are taking considerable action to help advance it. How do you think about the pushback that you see from various corners of the market?
Maybe I'll start again. I guess, I think, so we operate fairly globally, right? So we, our business and who we sell to is very global. And I guess in our experience, or in my experience, I would say, and even talking to some of the regulators, I don't feel as though the pushback is a global phenomenon. If I'm going to be more frank, I mean, there are pieces, some unevenness globally, but really, I do think that if there is a hardening and a pushback, it's mostly becoming, not even North American, but within the U.S. I'd even narrow it to the U.S. So I'm not sure if that pushback My colleagues and my impression is if there was some pushback in Europe, it's largely already feeling like it's starting to fade, so that it was very temporary, and the regulatory push continues to march on in the EU. And so I really, from my perspective, if I and I do have deep concerns, because I do think a bifurcation or a messy international regulatory world isn't good for anyone, and certainly does create a lot of inefficiencies and will slow down progress. So I don't think it's a good thing, but I do see that there's a real slowdown, and a concerted push and very political push in the U.S. to, I would say, slow down or push back against some of the, let's say, more aggressive ESG, let's say, regulation or at least policies. So that's my take.
Well, I think I think for such grand initiative, you would probably expect some pushbacks or some adjustment. Well, it's you don't just need like reporting agreement, but also you need to have agreement in measurements, monitoring, setting up the similar equal standards for different countries. So a lot of coordination, a lot of trust. So I think it's going to be very, very. It's not going to be easy, right? But I recall when I first came back to China in 2000. That was the time when China just began to adopt OECD corporate governance standards for listed companies. And also China tried to introduce independent director for public companies. And we have seen a lot of setbacks, a lot of reversions in the process. But eventually when the momentum gets built, it became irreversible. I think this is going to be probably the similar process.
In times like these, where there's widespread worries about a global recession and what's going to happen in the markets, the question about the relationship between corporate profitability and environmental risk becomes especially pronounced. I'm interested how each of you see that intersection. Is it clear cut, the relationship today, or is it murkier?
I say the dilemma, from my perspective, the dilemma of the question is that, let's say, the devil's always in the detail, and things are very heterogeneous. And like there isn't I don't think there's a simple relationship between the extent to which ESG considerations or environmental considerations are important to a company, and its profitability. That relation is going to be very complicated, and vary significantly across some industries and geographies, right? I guess maybe if I take a step back, and I often think of Sustainalytics as a barometer of willingness to focus on ESG issues, because we sell globally and we only sell products to companies or organizations that are focused on increasing their focus on this. Do you know what I mean? So in a sense, our sales are a reasonable barometer, and we sell globally, and our sales are pretty nicely divided globally. And I will say that we've the last 15 years haven't been the smoothest 15 years in history, from, let's say, volatility. And I will say that I found that even through like the financial crisis, that the attention paid to these considerations didn't drop at the same rate that the markets did, maybe, if I put it that case. So I'm certain there's a relationship, but I would say concern and focus on these issues have maintained some level of resilience, in my experience, over the last 15 years. I mean, I was taken aback by a number of the surveys that have been sort of publicly put out recently, with the willingness of corporates to step back and where they put it in there. And that's like probably the first, I would say. I was surprised because it was much stronger than I've heard or seen over like the last 15 years. So maybe there's something new afoot, in this pending recession. But historically, at least over my experience over the last 10 years, while there's a relationship, I think there's a stronger resilience, to the ability of companies to stay focused on this.
from the corporate point of view, I think what I see is similar to investment in brand equity during economic downturn. Should a company invest in it? So if you see it as intangible assets, critical to your mission and value proposition of your brands and company, I think good companies, sustainable company might do the opposite. I think that the challenges might not be the downturns or upturns of cyclical of the economy, but more on the mismatch between short-term business P&L expectation and the long-term goal of sustainability we are talking about. One is 20 to 40 years. The other one could be quarterly to a year or maximum 5 years. So this mismatch need to be synchronized. So because companies are not rewarded like brand assets, you have brand valuations that being valued as intangible assets. But for company mission-driven or invested in much earlier in decarbonizations, they are not rewarded accordingly. Perhaps also because due to the murky and subjectiveness of all the elements of EPS, ESG, but some elements like carbonization commonly have common ground, quantifiable. It's almost like a financial feasibility. You can audit it. There's a standards. So I think people are talking about like carbon adjusted earning per share. So this could be a future financial instrument to synchronize this mismatch, that to incentivize people to invest early and treat it as intangible assets. So that's something I think might solve this problem. So I don't think it is really linked to like cyclical of it, like just like people invest in brand equity. Thank you.
Well, in a lot of cases, obviously you're seeing we have to make a compromise between financial return and climate impact. However, we're seeing more and more examples, where climate initiatives can help usher in innovations which can both produce, reduce carbon emission and provide a better and cheaper products for consumers, and in turn, better financial return for investors. If we have more and more innovations that can achieve economic viability, financial sustainability, and climate impact altogether, we will be more likely to achieve the goals of carbon neutrality and carbon net zero soon. At CSC, we're particularly interested in promoting such innovations and capturing investment opportunities in areas such as renewable energy or promoting energy efficiency. To give you one example, I recently visited the startup company in Beijing, funded by a group of young entrepreneurs. Their product is an EV charge and storage unit, which features plug and play, easy installation, and allows the owners to enjoy a peak and off-peak electricity pricing gap. They have actually delivered 3,000 high-speed charging units to the European markets. I think innovations like this can not only benefit Chinese consumers, but also the rest of the world. So we're actively promoting innovations like that. Thank you.
Terrific. And we're getting several questions from the audience. So I'm gonna throw some of them to you panelists, and audience, please feel free to keep coming in. So on that theme of the innovations, in particular what's happening in the Chinese market, we have a question for James and Dr. Chi. The question is, what are the key challenges to the growth of ESG investment in China today? Would it be lack of a standardized rating framework, lack of suitable targets, lack of awareness, or would you cite other factors? Dr. Chi, do you want to, from the investment angle, do you want to start?
Well, I think China is, in general, I think very, very, proactive in this area, because the government has already set up, carbon neutrality, carbon net zero to be a national policy. Secondly, I think in China, we experienced, very severe pollution a couple of years ago. So the public awareness has also been rising. So there has been a lot of, initiatives addressing the climate change challenge. Well, I think we're seeing a lot of initiatives. We probably need more coordination and We also well, there's certain advantage which China enjoys, for example, manufacturing capacity. So in terms of renewable energy, China is pretty strong in areas such as photovoltaic cells production, etc. But I think that we do need still need to cooperate and learn from international peers. For example, common credit market in the US is far more advanced than China, and we would definitely need to learn from them. And in this investment of timberland, we got a chance to speak with our US colleagues in this area and learn from them. So I think we're definitely seeing a lot of progress in that sector. Also, I think there's one thing which the IC can do, which set us apart from other sovereign wealth funds, is we help our portfolio company, mostly in overseas market, to tap into China's consumer, vast, the huge consumer markets, and facilitate cross-border industry cooperation. I'll give you one example. One of our portfolio company is a thermal management company in the US. Starting from 2018, when we first invested in this company, we helped grow their business in China by 500% within 3 years. And they provide a better cooling solution to EV and cell phone makers in China to improve energy efficiency. At the same time, they provide a huge, well, by expanding into Chinese market, it provides more job opportunity for blue-collar workers in the US. So things like that, I think, can not only just address the climate change challenge, but also can promote international cooperation between, for example, China and the US.
Yeah, from my perspective, the social business that I'm managing is 10 years old now. We don't distribute dividend, so it's pure Nobel Prize laureate Muhammad Yunus model. So even though we are not making money, but we are at a break-even point at this moment. So when we look around our environment, we see a lot of social entrepreneurs are coming up. So there are around 40 companies certified, young companies certified as B Corp. They are basically social entrepreneurs. So we also see some impact investment are emerging, more of a mission-driven impact investment rather than like a double bottom line or triple bottom line. So I think ROI, maximize profits is still the main drivers, but at least we see ESG mission-driven investment, impact investors coming up. So there's some locally grown over the last few years. So it's still relatively young compared to advanced countries, but I think we see a good momentum in this area. Thank you.
Bob, this next question is directed at you from the audience, and it's related to your good point that some government involvement is going to be necessary in the market, considering the externalities involved. The questioner says it would be interesting to hear about the challenges of government's roles in an international setting on a problem such as climate change, when it requires much more coordination and is much more difficult as soon as you involve many countries. How do you think about the path forward there?
Yeah, I think the question sort of offers a lot of the answer. Is that, as the issue becomes more global and the response needs to be global, it's a much more complicated, let's say, problem to solve, and you really do need multilateral institutions to be participating. So at this, I do think that you need to have things like the EU and the other multilateral institutions that really need to be the anchors of these conversations and drive it forward. I do think I think many regulatory agencies understand the problem of fragmentation and conflicting policies. And so it is my experience, it feels like that often they are very conscious, of what's going on in differing just jurisdictions, and they do, though not formally, informally try to harmonize to the largest extent possible. And so I do think there's both, I would say, good policy decision making that occurs, where regulatory authorities do understand that they don't want to create a regulatory environment that is not navigable, by organizations. Like, that's clear to them. But I do think is that sometimes when the questions become really hard and the trade-offs become significant, then you really do need, that's what they participate in, right, at multilateral institutions and these global negotiations. But yeah, it is a tough issue, and I think, but I think it's a slow but sure progress is probably the best we can hope for.
The next question builds on that a bit, which is around greenwashing. So while it is important to your point to not handcuff markets in countries, greenwashing is a big concern in many corners of this ecosystem. And we at Bridgespan certainly hear about it a lot and are called in to think about how to prevent it on more of a systemic scale. I'm curious how you each see greenwashing, and specifically what mechanisms you think could disincentivize greenwashing today. And just, I guess, for the benefit of any of our audiences who aren't familiar with that term, greenwashing is a term used to describe the phenomena that occurs when someone claims that they're having positive impact on the environment, but does not in fact have that positive impact, and instead is just promoting it for the sake of brand building or for other interests that they may have. Do any of you feel like go ahead, Bob?
Yeah, so I'll speak to I'd say there's many markets where greenwashing can occur. So I'll speak to one of those sort of markets, which is the selling of financial products, right? Mutual funds or other things. And I think what you see the EU doing, with the EU action plan and their SFDR and all the stuff they're doing really is quite a concerted regulatory, I would say, attack, to, let's say, allow the tools necessary for addressing greenwashing. And I think what's interesting there is how comprehensive the framework needs to be, I think, to really address that. And what I'm talking about is part of their policy package is to create definitions. What is green definitionally, right? So I think that's really important. But that only works, that's only part of the solution, is that you need enough information. So once you've created the definition, you need the information, is the party doing those things? So you need reporting, out of the related parties, and that's significant. So you both need to, in their case, they're both passing disclosure regulations, so all the most important parties need to meaningfully improve their disclosure requirements. And they're creating the framework for the definition of what is green, so the disclosures can feed into that. And so it's a fairly comprehensive approach and quite heavy-handed, some would say, but I think within the financial product space, it is the right process. And it's been, if you've been connected to that process, it's huge, unwieldy. But I do really think they're doing the right things. And I think if you generalize that, I think you need standards, and then you need information that creates transparency that lets you understand, are those standards being met? And I think you need both of those things, and that creates a lot. So it's a fairly robust system if you need both those things. So maybe that's my take.
Dr. Chi, I think I see you talking, but we cannot hear you. There you go.
I just said I don't think I'm an expert on that, but you would expect to see a lot of fraud or whatever fake green growth or whatever. You will see that the people take advantage of the tax incentive or a policy incentive, or try to just to be to look good. In capital markets, you see things like that all the time. It's just it's going to be an evolving process where people develop a better measuring monitoring mechanism, and when institutions or corporates engage in fraud eventually got punished financially or legally, and then we're going to see less greenwashing. happening. So it's going to be a process.
I think for us, when we do our accreditations, we prefer to choose the highest standards available. For instance, carbon neutrality, we choose the PS 2060 standards, which is the most established over the last near 20 years. So we are also using CDP for our disclosures. CDP has been the largest and most established public domain for climate, water, and forest. Similarly for ESG, the more established, as well as B Corp certification, for instance, there is a 2 to 3 years rolling audits independent body. So I think for us, this gives us a more objective feedbacks for us to continue to improve. Yeah.
Interesting that you mentioned some of the widely used frameworks and tools out there. That is one of the tools of progress that I've seen in the field in the last several years. And our next question, Dr. Chi, is for you and relates to that, which is about the ESG valuation and ESG portfolios that you mentioned at CIC. The question is, when in your ESG valuation method, do you use a standard framework and use elsewhere in the world, or have you customized something for CIC? And in your ESG portfolios, is it all companies of all sizes and across all sectors, or do you have a targeted focus there?
Well, thank you. Our ESG evaluation process, I think that we learn from our international peers. We also have our our own unique features. So we try to learn the best practices and put them into our own practice. And in our ESG portfolio companies, well, we have quite a wide range of different companies. As I mentioned, we have companies which works in renewable energy, solar, wind, etc. We also have companies which produce better energy efficiency, and also sometimes software company which can help improve corporate efficiency, which reduce cost. So there could be a wide range of different companies, but anything which is good for economic efficiency, in general, is good for society. And of course, if it can help with climate change or deal with climate change, it will be better. So that's our angle. We try to strike balance between financial sustainability and climate impact.
Got an interesting question about equity from the audience, and specifically in the context of the widening inequities across the globe and the disproportionate burden and vulnerability of some of the poorer folks around the world living with fewer resources to adapt to climate change. Is there a moral system or a framework that's going to help ensure that we take on the burden in an equitable way?
I mean, I think I'm going to feel like I'm not really answering the question directly, but maybe I'll give you my take. But I think in many of these spaces, we have to talk about the policy or the tool or the application and make sure it aligns with the subject or the problem that we're trying to solve. And I think largely in this conversation, we're talking about how private markets, and the participants in private markets, are positioned to address problems. And I think at the scale that the person who made the question is talking about, when they're really talking about global inequalities that really happen at the national level a lot of the time, I don't know that this conversation, and the tools that are created, the ISB or CDP or us, like that's not the domain that we address, I guess is what I'm trying to say. So I think that really, if we're looking to address global inequalities, that stem across regions, then I think that's a different domain maybe than I think the one that, for the most part, that we talk about, which is, the application of ESG, or climate or impact to individual companies, and the contributions they can make, which can help, but I don't think that's the solution for that problem.
I think for corporations, we are in the nutritional business, foods and nutritional business. So accessing to nutritions, we do have kind of targets beside commercial. So the social business that I'm managing, for instance, is to increase the accessibility of nutrition to the kids that and families of needy. So we do have different initiative, but that tag along with our expertise and categories we are in, like for instance, safe water projects, worldwide nutrition. So we're more closely to our expertise, I would say, that we leverage this for the community. Yeah.
I don't have a very strong view on that, but certainly for countries at different stage, they would have different priorities. Probably developing countries would focus more on development and pay less attention to climate impact. But I think China has really made a very strong commitment, to achieve, carbon net zero carbon neutrality, goal, which I think is very, very good, very noble. And well, I think in international arena, you always have different views from different countries. But I think addressing climate change challenge is probably one area where people can have the most common ground, because ultimately we're living in one global or in one global village. So therefore, I would expect more consensus building in this area than anything else, even though it's going to be still not very easy, but I think it's achievable.
As we start to look ahead into the future, there's been an exciting influx of investment capital into the climate change space. And one of our questioners is asking about what you think the future holds, given the current geopolitical and economic situations and the uncertainty that they're introducing into the financial market globally, and whether you think that we'll see the same continuation and spike of greater investment to climate change, or whether you think we'll see it curbed. Bob, I might ask you to try to channel the U.S. investor angle for this question, given that there are many of your clients are from that set, and Dr. Chi, interested in what you see from the investment angle as well. What do the next few years hold for climate investing?
I guess I'll go first. So I guess within the American, I'm increasingly less comfortable, using the crystal ball because the world seems so volatile. So, I guess, looking a year or two in the future seems even harder and harder these days. But if I had to make a guess, I have a feeling that whenever there's, I think, rapid change, or so when there's a policy or a change afoot, there's sort of a cyclical cycle that goes on where there's rapid progress, then pushback, and then sort of an oscillation around a trend, I would say. And I think that's how I feel. That's my guess what's happening in the US. Like, this is part of, there was very rapid, I would say, movement in these areas. Like, I think the US moved more than most of us thought it would, in the preceding 3 years, or, like the way that the financial institutions embraced it. And so I do think the extent and the pace that ESG was embraced or adopted in the U.S. Was part of the pushback that occurred. It raced ahead, probably ahead of its sort of foundational strength, and this pushback is part of that. But I do think it's an oscillation around a long-term trend that's hard to get around. I think. I think the strength of the issue is so increasingly obvious, increasingly meaningful, that I think, though there may be short-term ups and downs, that the amount of investment in organizations that that are have a role in addressing the climate crisis, I think will increase over time. Like I said, there are probably oscillations, but I think that trend is in place and will steepen over time.
Excuse me. Well, I think unfortunately we're seeing quite a lot of geopolitical tensions in the past couple of years. I think the impact has been very severe. If you look at Europe, people probably have to make compromise. People have to they warm first. People have to try to survive first in a lot of countries. But we hope it's going to be temporary. Also, the geopolitical tension has severe consequences to damage trust between different nations, different countries, and we're seeing unfortunate deglobalization process in the past couple of years. But as a graduate from Chicago, I'm a firm believer that globalization, free trade, exchange of competitive advantages between nations will still, take place, will still continue, in the future, in the long run. We're seeing some setbacks, which is, acceptable. It's a natural part of the process. I mentioned, two companies. One, U.S. company, coming to China, we help them. Expand their business in China, and I also mentioned a Chinese company startup, which potentially will help achieve better energy efficiency in Europe, or probably someday in U.S. market. If we do more things like that in our investment process, I think we're going to make this world, better. We're going to try to build trust between different countries and hopefully coming together. Going forward. Yeah, thank you.
We have a question following up on the conversation we'd had on greenwashing a moment ago. This question asks, how do you judge whether a company is greenwashing? What does that look like, or how do you identify it? Any examples come to mind?
Yeah, I don't feel so excited to say shame. I mean, in the moment, but I would say, there have been oil and gas, companies who have talked about, a transition to a new fuel future, a new energy future, where they've really talked up, I would say, their transition, and and really where underneath it not a lot was going on. So I do think, when we talk about greenwashing, we're talking about the difference between the promise and the reality, maybe is the way to put it. And I think that, that happens a fair bit, because I think there's a fair bit, once there's a motivation that people believe there's a market or there's a benefit to portraying yourself that way, and there's an economic benefit to be gained, then you want to portray yourself that way. And then if you're not truly committed, or if there's not a framework, then you tend to cut corners, I think, right? And so I think that split between incentive but limited downside, if you're not caught, kind of creates the fertile ground for greenwashing to occur. And, and I think the goal here is to make that more difficult. I think that we want a narrowing between the promise and reality, of what firms are doing. And I do think in many places that's getting better. I mean, so I don't think this is all, I think and there's a huge regulatory attention being paid to greenwashing now. And that really is, I think, at the heart of many of the regulatory regimes coming into place. And so as much as I think it's an issue, I do think there's a lot of positive momentum, I would say, going on here. So,
James or Dr. Chi, any other perspectives? Otherwise, we will move on to our final question.
Yeah, I think for us, for instance, why we take a long journey in decarbonization. For instance, in China, we started in 2008. That is a 13 years journey. And even today, you're merely talking about the carbonizations, carbon neutral of the factory. some of these works are enormous. So the factory contribution to emission is, we are talking about less than 10%. So many are indirect. So I would say it's a very long journey. One example is packaging materials. Emits from petroleum byproducts. So you have a lot of emissions. It accounted for 30% of some of the product category, like mineral water, beverage. So to resolve this, so it is like a 30, 40 years kind of journey. So the first 10, 15 years, what we did is to convert our materials from the non-recyclable to recyclable materials. For instance, in China, we have all our products now made of recyclable materials. That took us a long, long time, because including the ink, which is soluble, the sleeve, that when the recycling in the factories did the recycling, they do not have to take out the sleeve. So it's the same material for the bottle and sleeve. That's easing the recycling process, create higher value for the waste packaging. So this already takes some time, and now in Europe, some of our products are made of recycled PD. So you need to do a lot of food safety evaluation. So it's a 10 years journey. So it might be 20 years to allow these recyclable materials used in food products, because food safety. So what we see is that if you are doing it too shortly, so then the credibility is a question. Like, for instance, if I get my factories to be carbon certified in 1 or 2 years, most likely you spend a lot of money on offsetting, right? So you are planting a lot of trees rather than using efficiency to reduce your own carbon emissions. Employee engagement, education, discipline. So there are a lot of hard works in the day-to-day operation that is very important to drive the emissions. And then the rest from the offsetting is trying to not to over-reliance on the offsetting. So I think that the time horizon, the sacrifices, the real meaning of decarbonization, that's more sustainable, I would say, rather than sacrificing the P&L, right? So I think together with suppliers, I think it's a long journey for that. Yeah.
Well, just quickly add some comments. I think if you look at the green industry, if we can call it industry, it's very much like a market. It's like a financial market. You first need to set up a standard, which is consensus has to be built over time to reach equal standard for different participants. Secondly, you probably need a third party or independent agency to evaluate those parameters of whether it's green or not green, or greenwashing. Thirdly, you probably need regulator eventually, or collective regulatory mechanism among different nations, and so that it will become a more effective ecosystem to make it work. It's not going to be just taking place overnight. But I think going forward, I'm sure such an ecosystem will gradually evolve.
Yeah, the progress has been exciting, and the road ahead is also will also be long. And great point. And as we wrap, I would love to ask each of you one final question as you think about that road ahead, which is, what is one thing you would advise corporations, investors, or regulators to keep in mind in order to continue advancing the progress on ESG and climate responsibility? Bob, could you share one thing for regulators to keep in mind?
Sure. I mean, I think most important, I think a solution, the scale of the problem requires, I think, quite a lot of innovation and a lot of transformation. And I think, a mistake by the regulators would be to over-regulate. In doing so, I think you typically add a lot of rigidity, and you often, like, if you look at, if they were to regulate the markets or regulate us, like the credit rating agencies, you create rigidity. And I would say, and that would be I don't think we're in the right moment for that kind of rigidity to be in the space. And so I think they need to be very cognizant of what their outcome they're trying to create, and trying to create too much clarity and stability and alignment will come at the cost of innovation. And I'm not sure we're ready or at that stage yet. So I think that would be my biggest concern.
James, could you speak to one thing corporations should do?
Yeah, I think climate is a complex issue. I don't think there's a single solution for one company. The company should open up, exert its influence to its ecosystem, and then have collective actions together. As the time is clicking, we have seen the summer record size of heats and drought this year. Time is running out, so I think if there is a collective actions along different ecosystems, I think this might help to reduce the gaps, and then to be the purpose of all corporations, institutions. Thank you.
Dr. Chi, would you be able to share one thing from the investor perspective?
Sure, thank you, Stephanie. Well, I think climate change is probably not the first challenge that human being has faced during our long history of development. And like all the other challenges, we have faced before, they eventually got overcome. We should have faith that this challenge should also be overcome someday. And I think the key, as I said, is innovation and cooperation. Here at CIC, we will still, continue to do more to promote innovation in this sector, and also, promote cross-border industry cooperation to build more trust between different countries. Thank you.
Thank you. I would like to thank our panelists today for such an engaging and timely conversation, as well as for all of you joining us on Zoom. And I'd like to invite you to the next panel titled The Impact of Climate Change on Human Health, which will be held on Tuesday, October 25th at 7 p.m. Central Time, or Friday, October 26th at 8 a.m. China Standard Time. Thank you all again. Very much appreciate all of our panelists' wisdom today, and look forward to engaging with this group again and advancing on these important issues.